Hi everyone, welcome to the Property Ponderings podcast. My name is Craig Nichol, real estate agent at Nichol Real Estate in Melbourne, Australia, where we buy, sell and renovate properties for our clients. I'm bringing to you over 15 years of property experience as an agency owner, property investor, renovator, town planner, salesperson, auctioneer and buyer's agent. I want you to make better property decisions and build the future that you are chasing. Today we're talking about a strategy that many first home buyers and property investors are often tempted by, chasing property hotspots. It's a strategy that promises quick gains and high returns, but the reality is that it often falls short and may even set you back in the long term. Today I want to explain why chasing property hotspots is not the path to a sustainable property wealth portfolio. I'll be drawing on insights from legendary investors like Warren Buffett and other renowned figures to back this up. So firstly, what are property hotspots? Property hotspots are typically defined as areas where property prices are rapidly increasing, often driven by high demand, new infrastructure or media hype. The idea is simple: buy in these areas before everyone else catches on and watch the prices skyrocket, and then sell or leverage the equity into your next investment. Sounds like a great plan in theory, but in practice it rarely delivers the consistent long-term returns that most buyers are hoping for. A major reason for this is that hotspots are often influenced by short-term trends, speculation and market psychology rather than solid fundamental growth factors. The best example of this is mining towns, where there's a new mine that opens up and then there's a lot more workers that come in that need accommodation and prices can be pushed up in an area. But then as soon as that work dries up or the mine closes, then suddenly the demand goes from 100 to 0. To put this into context, let's turn to one of the world's most successful and respected investors, Warren Buffett. While Buffett isn't a real estate investor per se, his investment portfolio is rooted in long-term value creation, and his principles can be directly applied to property investment. Buffett famously said, "Be fearful when others are greedy and greedy when others are fearful." And what he means is that when everyone is rushing into a hot market, it's often driven by greed and the fear of missing out, not by rational analysis. By the time you hear about a property hotspot, the easy gains have usually been made, and you may end up paying a premium for a property that's already peaked. Instead of chasing trends, Buffett advocates for investing in assets that have strong intrinsic value, assets that you would be comfortable holding even if the market were down for the next 5 years. In the context of property, this means focusing on locations with solid fundamentals, steady population growth, good infrastructure, employment opportunities, and a diverse local economy. Chasing hotspots, by contrast, is often speculative and can lead to short-term gains but long-term disappointments. Now, research consistently shows that trying to time the property market or chase hotspots is a risky endeavour. According to CoreLogic, areas that experience rapid price growth often face a subsequent cooling period or even a price correction as demand wanes and initial excitement fades. A study by Michael Yardney, a well-known property investment strategist, also supports this. He analysed over 30 years of property data and found that long-term capital growth in hotspot suburbs rarely outperformed established blue-chip suburbs. Hotspots often produced a brief period of rapid growth, followed by stagnation or decline, especially if the growth was driven by one-time events like new infrastructure or developer marketing rather than a sustained demand. So why do so many people still fall for this trap? It's because the psychological bias known as recency bias. When we see recent price surges in the area, we tend to assume that the trend will continue indefinitely. But real estate markets, like all markets, are cyclical. What goes up often comes down just as quickly. Another danger of chasing hotspots is the risk of overpaying. When a suburb becomes a hotspot, competition drives prices up quickly, and buyers driven by a fear of missing out often end up paying more than the property is worth based on fundamentals. This can significantly diminish your long-term returns. In a hot market, many buyers also get caught up in emotional decision-making. They might rush to purchase without proper due diligence or without considering the long-term prospects of the area once the initial hype dies down. This could lead to situations where the buyer is left holding a property that underperforms or is difficult to sell in a cooler market. And for many people in Sydney, Melbourne, since 2022, buying in that sort of period and then now trying to sell in a much more difficult period, would have felt that many of their properties have underperformed, especially in Melbourne, even over the last sort of 5-year period, feeling like their property's underperforming and then trying to sell and trying to chase their tail and getting their money back. Another really important thing to remember here is that hotspots themselves are quite difficult to pick before they've actually spiked. So often you're jumping into a market that's already moving. Let's say Perth at the moment, jumping over 20% in the last 12 months. Jumping into a market now in Perth, you're getting in when a lot of those gains have occurred. Of course, this could still go, but the risk gets higher as you're later into that market, and you could potentially end up in a position where the market does cool. And as we've seen in Perth, WA, it can cool for many years, and then you are left sort of holding the baby and not being able to sell, and potentially selling at a loss. If you're not jumping into a market then that's already spiked, the other thing is you're potentially guessing a hotspot that just doesn't spike at all. So those are the two categories that a lot of investors and property buyers are falling into. Either they're buying when the market's already moved and the risk is increasing because of their timing, or they're picking a hotspot that just doesn't go at all, or potentially goes backwards. So what's the alternative? I suggest adopting a value investing approach, much like Buffett does with his stocks. Instead of focusing on hotspots, look for properties in quality locations with proven long-term growth potential. And this is much of the stuff that we've spoken about in my earliest podcasts. These areas might not offer the excitement of a hotspot, but they are more likely to deliver steady, reliable growth over time. One of Buffett's core principles is to buy assets at a fair price and hold them for the long term. In real estate, this means investing in established suburbs with strong fundamentals, with proximity to employment hubs, good schools, public transport and lifestyle amenities. And these are areas that continue to attract demand regardless of the broader market conditions. Let's take Melbourne for an example. Established areas like Hawthorn and South Yarra don't make the hotspot list, but they have a proven track record of steady capital growth over decades. Properties in these areas may seem expensive compared to emerging hotspots, but they tend to maintain their value and perform consistently over time, even during market downturns. Understand that these areas are very expensive, so a lot of people cannot buy into these areas. I'm just using these as an example because everyone knows that these suburbs have the characteristics of really good fundamental long-term growth, and those are the drivers that we are looking for. And there are many other suburbs around Australia that are in much more affordable price ranges that have those same fundamentals being met. They have good schools, they have great services, they have ease of access to different employment hubs. They've got a lot of people that just generally want to live in these areas, and it's consistent. And the consistency is what we are looking for here, as opposed to the speculation and the immediacy of pressure on hotspot markets that may dissipate at any point in time. Number 2, think long term. Look for properties that you'd be happy to hold for 10 to 15 years, not just the next 2 to 3 years. Remember that property is a long-term game. Number 3, avoid FOMO. Just because everyone else is jumping into a hot market doesn't mean it's the right move for you. Stick to your investment strategy and don't be swayed by the hype. Number 4, do your own research. Don't rely solely on hotspots or media articles. Analyze data on population growth, rental yields, infrastructure developments, and local amenities. And number 5, seek professional advice. Consult with a buyer's agent or a property advisor who has local market knowledge and can provide an objective analysis of the property's true value that you're looking at. So to wrap up,